Hi, welcome to Learn Much Tree. This is the fifth video on leverages. In the previous video, we looked at problem 2 and problem 3. In this video, we'll be looking at problem 4, 5 and 6, and this will be the last video on leverages. I'm not going to take the first problem in this video for discussion, which is problem 4. This problem has appeared in many exams in the past, so let me put that out here. So this problem has appeared in November 2011. This has appeared in May 2014. This has appeared in May 2016, and this has appeared in November 2018 and also in November 2019. So in 5 exams this has appeared, and you can also see this in 2 RTPs, definitely. RTP May 2019 and RTP May 2016. So 2 RTPs and 5 past exams. From the information given in the following 2 tables, prepare the income statement and calculate the operating, financial and combined leverages. A balance sheet is there and you have some additional information. So there are 2 requirements in this question. One is to prepare the income statement and other is to calculate the 3 leverages we have been seeing. So let me go ahead with the first requirement of the question, which is preparation of the income statement. The starting point is going to be sales. You can observe in this question that we don't know what sales is, and this is something that we would need to calculate. We have to use information given in the question to calculate sales first, and once we do that, then the construction of the income statement is going to be very easy. How do we calculate sales here? I'm going to use something given in the question called as total asset turnover ratio. This is given in the question and I'm going to use this for the purpose of sales calculation. This is very similar to the capital turnover ratio that we saw in problem 2. So here also I'm first going to define the ratio and use it to calculate the value of sales, and once we do that, before I proceed with the income statement, let's just take a quick look into what this ratio would mean. So total assets turnover ratio is defined as sales divided by total assets. When I say total assets, it refers to non-current and current assets. Total assets, sales divided by total assets. So in this case here, I know the total assets, it is 100 lakhs. This is the total of non-current and current assets. I know the ratio, it is 5 times. So what I don't know is the sales. Obviously, if I do a quick reverse working, I will know that my sales is 500 lakhs, which is basically total assets into the total assets turnover ratio. So let me put my sales here, which is 500 lakhs. Now, before I go ahead with the remaining part of the income statement, let's take a quick look into what this ratio would mean. This ratio looks at the relationship between the total assets deployed in the business and the sales that the business is able to generate. The assets are what help in the generation of sales, and the relationship between the assets deployed and the sales generated is measured by this ratio. For example, if I take a total assets turnover ratio of 5 times, what would this mean? This would say for every 1 unit of assets deployed, 5 units of sales is generated by the business. So if I have 1 rupee of investment in assets, then I probably generate 5 rupees of sales from that. That's measured by the total asset turnover ratio. So just like the discussion we had in problem 2, when we looked at the capital turnover ratio. Here also, an increasing ratio, an increasing total asset turnover ratio would indicate better efficiency in assets, in usage of assets. For example, let us say this year the total asset turnover ratio for this company was 5 times, and the next year let's say it becomes 7 times. So that would mean that in the next year, for every 1 unit of assets invested in, 7 units of sales can be generated. But in this year it's just, let's say, 5 units of sales. So we understand that for the same 1 unit of assets, in the next year our generation of sales has become much better. So we say that the efficiency in the usage of the assets to generate sales has improved. Similarly, if I find the total asset turnover ratio reducing, then I would say that the efficiency in the usage of assets to generate sales is also reducing. Let's say 5 does not become 7, let's say 5 becomes 3. Then in that case, in the next year, for every 1 unit of assets, the sales that is generated by the business is only 3 units as against 5 units. So from 5, if the ratio drops to 3, that definitely indicates lesser efficiency in the usage of assets to generate sales. So that's how I would understand total assets turnover ratio. This is very, so again, as I said, this is very similar to capital turnover ratio. So using this, I got my sales. Now the next thing I need to look at is the variable cost ratio, which is 60% as given in the question. So this is going to be 300 lakhs. If I subtract that, I will have 200 lakhs, and that is going to be contribution. From contribution, I am going to subtract operating fixed cost. This is also given in the question, and this is 20 lakhs. So if I subtract this, I get 180 lakhs. This is called EBIT. And from this, I subtract interest. And in the question, I have a debt value of 50 lakhs at a 12% rate. So that would give me 6 lakhs of interest, 12% applied on 50 lakhs. So if I subtract interest, I get EBT, earnings before tax, 174 lakhs. The tax rate in this question is 25%, so minus tax at 25%. So I have to calculate 25% of 174 lakhs. So that is 43 lakhs 50,000. So let me subtract this number. This is the tax at 25%, 43 lakh 50,000. I get earnings after tax. So that is 130 lakhs 50,000. This is the earnings after tax. Now if I divide this by the number of shares, yes, so here the share capital has a total value of 25 lakhs and the shares are of rupees 10 each. So that means I have 2,50,000 shares. So if I divide the earnings, let me put that here. If I divide earnings after tax by number of shares, then I get my EPS, earnings per share, so which is going to be 130 lakhs 50,000, which is 1 crore 30 lakhs 50,000 divided by 2 lakh 50,000. So let's see what that is. 52.2. This is the earnings per share. So I didn't have space, that's why I came here, but this is also a part of the income statement. So this addresses the first requirement of this question. Now the second requirement of this question is to calculate the three leverages: operating leverage, financial leverage, and combined leverage. So that's pretty simple. Let's quickly do that. Operating leverage is equivalent to contribution divided by EBIT. This is the formula that we saw. Financial leverage is EBIT divided by EBT, and combined leverage is contribution divided by EBT. Alternatively, I can also calculate this as operating leverage into financial leverage. So let me go to the income statement to fetch numbers. So 200 lakhs contribution and EBIT is 180 lakhs. So 200 lakhs of contribution and EBIT is 180 lakhs. And so this is going to give me 1.11 times. So my operating leverage is 1.11. My EBI, now when I come to financial leverage, my EBIT is 180 lakhs and my EBT is 174 lakhs. So let's see what is the financial leverage. That is 1.03 times. When I come to combined leverage, it is 200 lakhs divided by 174 lakhs, and that is 1.15 times. This is the combined leverage. So operating leverage, financial leverage, and combined leverage. This is the second requirement of this question, and this is the solution to problem 4. So again, problem 4 has appeared in 5 exams in the past and in 2 RTPs, and yeah, this is a very simple problem, and we can see that as we do this problem. As we did this problem, we could have seen how easy this is. Okay, let's go to the next problem, which is problem 5. Problem 5 is a pretty interesting one. Problem 5 is also a past exam question. This has appeared in the May 2012 exam. This is problem 5. There are 3 requirements in this question. Please calculate the following. 1. Operating and financial leverage. 2. Cover for preference and equity dividends. 3. Earnings yield and price earnings ratio. So in this question, only the first part of the question is directly related to leverages. The second and third part, they are from this topic called as ratio analysis. So as I said in the previous video, a lot of questions in leverages do not have testing only from leverages. They also have some bit of questions that come from some other topic also, and most probably is generally ratio analysis. So that is something that we can see in problem 5 as well. So only the first part tests you in leverages, the second and third is from ratio analysis. Never mind, let's see what this problem has in store for us. So you're given the breakup of the total capital, equity share capital, preference shares and debentures, and you're also given some other details: profit after tax, tax rate, operating expenses to EBIT, depreciation included in operating expenses 90,000, equity share dividend 15%, market price per share rupees 20. So let's first go ahead with the first part of the question, which is calculation of the operating and financial leverage. But to do this, we need to construct the income statement. Only if we do that, we get the numbers in place, and from those numbers we can calculate the leverages. So first I'll go ahead with the income statement. Here, in the calculation, the preparation of the income statement is to be done by doing a lot of reverse working. So I can call this problem 5 as a reverse working question. So if you see here, we have profit after tax. We have profit after tax, and this profit after tax is given as rupees 1,82,000, is given as rupees 1,82,000. Now let me probably put this here. Profit after tax is 1,82,000. Right. We know that the tax rate is 30%. So there would have been a profit before tax, and 30% of this would have been paid as tax, so 30% of PBT. So PBT minus 30% of PBT would have given us PAT. So that means I can say that the PAT represents 70% of PBT. So PAT is 70% into PBT. That means PAT divided by 70% gives PBT. So given the profit after tax and given the tax rate, I am now reverse working and calculating the profit before tax. So let's do that. 182,000 divided by 70%. Let's see what we get. So this is 2,60,000. So this is 2,60,000. So let me write here profit before tax 2,60,000. Just to complete the income statement, let me subtract. Let's just fill up these things. So let's see what our tax would be. This would have been 78,000. So yeah, this is just for completion. So I get my profit after tax. Now, I have the PBT now, and that is 2,60,000. PBT itself would have been calculated as PBIT. When I say PBIT, it means profit before interest and tax, which is also earnings before interest and tax, minus interest is equivalent to profit before tax. So, which means my profit before interest and tax is equivalent to profit before tax plus interest. This is 2,60,000. And interest is something that I can calculate looking at the first table in the question. I have 4 lakhs as the debt value, and this is at a rate of 10%. So if I apply 10% on 4 lakhs, I get 40,000. So 2,60,000 plus 40,000 gives me PBIT of 3 lakhs. So I have my PBIT of 3 lakhs, from which I subtract, this is just for completion again. So if I put this 40,000 here, this completes my statement. Now I have PBIT. Now, let me look into the next table where I have a ratio called as operating expenses to EBIT 1.5 times. So my EBIT, which is basically my PBIT, it is 3 lakhs, and the ratio of operating expenses to EBIT is 1.5 times. That means my operating expenses is going to be 1.5 times of my EBIT. So which is basically 3 lakhs into 1.5. So the ratio says operating expenses by EBIT is 1.5. So if I know the EBIT, I know that my operating expenses is 1.5 times of that, which is going to be 4,50,000 here, which is going to be 4,50,000. So the total operating expenses, the total operating cost is going to be 4,50,000. But I need to segregate this operating cost into fixed cost and variable cost. This is because I need to construct the income statement showing the segregation. Only then I'll be able to calculate the leverages appropriately. So I need the segregation between fixed cost and variable cost. How do I do that? If I look into the Second table in the question, it says depreciation included in the operating expenses is 90,000. So I assume that depreciation is a fixed cost. So let me put here depreciation fixed cost 90,000. That would mean the balance of 3,60,000 is going to be variable cost. That would mean the balance of 3,60,000 is going to be variable cost. Now, this logical question, is this 90,000 the only fixed cost? Here we assume that this is going to be the only fixed cost. In the absence of any other information, depreciation is definitely a fixed cost, and I would assume this to be the only fixed cost. So let's say fixed cost is just 90,000 and the entire balance of operating cost is assumed to be variable cost. So contribution minus fixed cost gives us EBIT. So if I know my EBIT and to that I add the fixed cost, I'll get contribution. So fixed cost is 90,000. So this would mean my contribution would have been 3,90,000. Contribution would have been 3,90,000, and from that, if I subtract 90,000, I would get my PBIT. And I also know that variable cost is 3,60,000. Sales minus variable cost gives us contribution. So if I know contribution and variable cost, I can say contribution plus variable cost is sales. My contribution is 3,90,000 and my variable cost is 3,60,000. So adding both would give me my sales, 390 plus 360. So my sales is 7,50,000. So let me put my sales here. The sales is 7,50,000. So I have now constructed the income statement. So this was reverse working. Let me quickly recap the steps that I've taken. I started with PAT. I took the tax rate. I used both of these things together and I got the PBT, which was 2,60,000. So this was the first step. Then using the PBT and the interest, I reverse worked and got the PBIT. This was the second step. Using the PBIT and the operating expenses to PBIT ratio, I got the total of the operating expenses to be 4,50,000. This was the next step. This operating expenses, I segregated this into fixed cost and variable cost. Fixed cost was the depreciation component and the variable cost was the balance. So using the PBIT and fixed cost, I reverse worked and got the contribution, which was 3,90,000. And using the contribution and the variable cost, I reverse worked and got my sales. And now I have the entire income statement in front of me. So this was obtained by reverse working. Now the first part of the question wants me to calculate the operating and financial leverage. We know, let me do this calculation quickly here. Operating leverage is equivalent to contribution divided by EBIT. So we know that. So here it's going to be 3,90,000 divided by 3 lakh. So this is going to be the first leverage, operating leverage, which is 1.3 times. It's going to be 1.3 times. So this is operating leverage. And the next requirement is financial leverage, which is EBIT divided by EBT, and that is going to be 3 lakhs divided by 2,60,000. That would be 1.15 times. Yes. So we have calculated the operating leverage and also the financial leverage, and thereby we have answered the first part of the question. We've taken care of the requirements of the first requirement of this question. The next requirement asks us to find, the next requirement is to find out the cover for the preference and equity dividends. So let's see what is meant by this? What do I mean by the cover for preference and equity dividends? So let me continue the income statement from PAT. I have my PAT to be 1,82,000. Now, does this number entirely belong to equity shareholders? The answer is no here, because we do have preference shares. So from this, first we need to pay off preference dividend to the preference shareholders. Only the balance would belong to the equity shareholders. So here I have 6,25,000 of preference shares, and they have a preference dividend rate of 8%. So 6,25,000 into 8% is going to give me 50,000 of preference dividend. So I will get 1,32,000, and I will call this as profit available to equity shareholders. PAES, profit available to equity shareholders, 1,32,000. Let me look at the first one, which is called as cover for preference dividend. I'm going to first define this. We are going to calculate this then, and then we'll take a quick look into what we mean by this calculation here. Cover for preference dividend is defined as profit after tax divided by preference dividend. So the cover for preference dividend is defined as profit after tax divided by preference dividend. So it's going to be 1,82,000 divided by 50,000. So this gives us 3.64. Even this will be expressed in terms of number of times. So 3.64 times. So this is the definition of the ratio which we call as cover for preference dividend, and this is the calculation. Now let's take a quick look into what we mean by cover for preference dividend. See, the company has an obligation to pay the preference shareholders rupees 50,000. So this rupees 50,000 is what I'm going to call as company's obligation to preference shareholders. The company let's say the company wishes to know whether it has enough profits from which it can pay this preference dividend. The company has an obligation to pay 50,000 as dividend to preference shareholders, and the company wants to know whether it has enough profits from which it can pay preference dividend to preference shareholders. What we understand here is that the obligation is 50,000, but the profits available from which you can pay off this obligation is 1,82,000. So we say that we need 50,000 to pay to shareholders, preference shareholders, but we have earned 1,82,000, which is basically 3.64 times of 50,000. So this is what is meant by the cover for preference dividend. While we need 50,000 to pay as dividends to preference shareholders, we have earned 3.64 times of that in the PAT level. So the cover for preference dividend is 3.64 times. So the PAT from which the preference dividend has to be paid gives a cover of 3.6, covers the preference dividend by 3.64 times. So any coverage ratio, the obligation or what you have to pay or what you want to pay is the denominator, and the numerator is from where you have to pay that. From where you have to pay that comes in the numerator, and what you need to do comes in the denominator. You have to pay 50,000, and from From what number do you need to pay this 50,000? From your 1,82,000. So you have definitely a lot more than what you need, and in fact you have 3.64 times of what you need. So that is what you mean by the cover for preference dividend. So the higher the number here, the more number of times your PAT would cover the preference dividend. So there is probably a little less for the company to worry in relation to availability of profits to pay preference dividend. But the lesser and lesser the cover, the more the company would probably have to worry in terms of availability of profits to pay the preference dividend. For example, let's say the cover was exactly 1. That would mean that what you have to pay is 50,000 and what you actually have as PAT is also 50,000. Well, you exactly have what you need. But if the cover is lesser than 1, then it probably says that what you have is lesser than what you need. So let's say here PAT was 40,000, then our cover would be 40 by 50, that would give us 0.8 times. So you only have 80% of what you need. So a cover of 1 tells you exactly have what you need. A cover of lesser than 1 says that you have much lesser than what you need. And a cover of more than 1 tells that you have much more than what you actually need. So that's how probably we would look into, we would try to understand cover for preference dividend. Now, the next thing that we need to look at is what we call as the cover for equity dividends. That's the next requirement, cover for equity dividends. Again, let's look into the definition. Let's just go for the calculation, and after that we'll take a quick look into what this would mean. This is defined as PAES divided by equity dividend. PAES divided by equity dividend. PAES is profit available to equity shareholders. This is 1,32,000 in our problem here. What is the equity dividend? In the question it tells it is 15%. So generally equity dividend is given as percentage on face value. So here when I say 15%, it is 15% of share capital. It is 15% of share capital. So here it is going to be 8 lakhs into 15%. So that is going to be 1,20,000. So my equity dividend is 1,20,000. So I put that here. So PAES divided by equity dividend is the formula for cover for equity dividends. So let's calculate that. We get 1.1 times. So this is the definition, this is the calculation. Now we'll take a quick look into what we mean by the cover for equity dividends. The understanding is very similar to what we had in the previous case where we looked into cover for preference dividends. The company wishes to pay 1,20,000 as dividends to equity shareholders. But from what would it pay this 1,20,000? It would pay from profit level of 1,32,000. See, it is only this 1,32,000 that is available to equity shareholders. You can't say 1,82,000 is available because in that 1,82,000, 50,000 belongs to preference shareholders. So what is available to equity shareholders is only 1,32,000, out of which the company can pay dividends to equity shareholders if it wants and can retain its profits if it wants. So this company in our example here, in our problem here, wants to pay 1,20,000 as equity dividend, and what it has available from which it can pay this dividend is 1,32,000. So the relationship between what the company wants to pay and what it has from which the payment can be done is measured by this ratio. So the company wants to pay 1,20,000, the company has 1,32,000, so the cover is 1.1 times. So what the company has covers what it wants to pay by 1.1 times. So here again, if the cover is exactly 1, it would mean that the company has what it wants to pay. If the cover is lesser than 1, the company does not have what it wants to pay. And the cover is more than 1, it would mean that the company has more than what it wants to pay. Here the cover is 1.1, so it's just a little more than what the company wants to pay. For example, instead of 1,32,000, let's say the PAES was 2,40,000, then the cover would have been 2 times. So the company wants 1 unit of payment and the company has 2 units for that. But here that's not the case, it's just 1.1 times, so it just has a little more than what it wants to pay. So that is how we understand cover for equity dividends. So the understanding is very similar to the cover for preference dividends. But between the two, what is important to note is that equity dividend is at the complete discretion of the company, and but preference dividend is not completely at the discretion of the company. It's generally a fixed rate applied, and compared to equity dividend, that is definitely a preferential treatment given to shareholders. So in terms of the company's flexibility to make dividend payments, I would say the company has a lot more flexibility here than in the case of preference dividends. So what this would mean in terms of cover is, if the cover for preference dividend is dropping year on year for the company, that's a lot more for the company to worry about than if the cover for equity dividends is reducing. So here this payment is not compulsory, but compared to this, the payment for preference shareholders is relatively compulsory. So that is what this would mean in terms of cover for preference dividends and cover for equity dividends. So this answers the second requirement of the question. So we've answered the first requirement and the second requirement. Now we need to go to the third requirement, where what we are asked is two things. We are asked earnings yield, and we are also asked price earnings ratio. Price earnings ratio. Again, these are part of your ratio analysis chapter. So like we have done for any other ratio, we'll first look into the definition, we will look into the calculation next, and then we'll take a quick look into what these ratios would mean. So let me first take, I would first take price earnings ratio. Price earnings ratio. Price earnings ratio is defined as market price per share divided by earnings per share. Market price per share divided by earnings per share. So in the question, we are told that the market price per share is 20. We need to calculate the earnings per share. So we know that the earnings available to equity, let me calculate this here. Earnings available to equity shareholders is 1,32,000. We need to know the number of shares here. Well, that's not given in the question, so let's assume that to be, let's say shares have a face value of rupees 10. Let's say shares have face value of rupees 10. Let's assume that way. So that means 8 lakhs of equity share capital, 10 rupees of face value. So number of shares would be 80,000. So we will get earnings per share to be 1,32,000 divided by 80,000. That's going to be 1.65. That's going to be 1.65. Earnings per share is 1.65. So we assume that the shares have a face value of rupees 10. So earnings per share is 1.65. So let me put that here, 1.65. So 20 divided by 1.65. So I get 12.12 times. I get 12. Even price earnings ratio is generally expressed in terms of number of times, 12.12 times. So this is price earnings ratio. So this is the definition and this is the calculation. So definition is market price per share divided by earnings per share, and the calculation is 12.12, which is basically here in this case 20 is the market price per share and this is the earnings, and this is how we calculated that. Yep. Now let me take a quick look into what price earnings ratio would mean. So first of all, let me tell you that there can be a lot of discussion that we can make around this price earnings ratio. A lot of discussion. There is scope for very detailed understanding of price earnings ratio, and the scope for a lot of application of this ratio also. But in our discussion right now, at the intermediate stage of CA, when we look at FM now, we just need to know what price earnings ratio would mean at a very high level. So that's what I'm going to discuss now. So I just want to let everybody know, whoever is watching this video, I want you to know that there's a lot of application here and the scope for a lot of detailed understanding here. But we're not going into all of these things here. We are just looking at the high level idea of what we mean by price earnings ratio, because that is what is required at the intermediate level. But when you take up to CA final studies, when you look into SFM, strategic financial management, we'd look into a lot more of this. You would be looking into a lot more of price earnings ratio. And when you take up to other courses relating to finance and investments like CFA, then you'd still look deeper into price earnings ratio. So there's so much around price earnings ratio. I just want to say that before I tell you what we mean by price earnings ratio at a very high level. So you should not think that this is all. You should know that there's a lot more, but we are just restricting our understanding to things at a very broad level. Now, let us take an example. Let's just probably ignore this for the time being. Let's take an example. The market price of a company's share is 20 and the earnings per share for this company is 2. This would mean, based on our definition, the PE ratio would be 10 times. The meaning of this is, what do I mean by, first of all, what do I mean by earnings per share? For every one share, what has the company earned? This is what I mean by earnings per share. Let's assume we are talking just about one share here. For one share, this company has earned 2 rupees, and for a share which has an earnings of 2 rupees, the price that the market is willing to attribute is 20 rupees. What do I mean by market price per share? The price per share in the market. When I say market, here I refer to the share market or the stock market. So market price per share is the price at which the share can be bought or sold in the market. So that is basically the value attributed to that share in the market. And in our example, in our problem here, it is 20 rupees. So the market, which is basically the collection of buyers and sellers, they have placed a value of rupees 20 on this company's share. That's what we mean by market price per share. So for this company's share, which has earned rupees 2, the value placed on it is 20 rupees. So the market is placing a 10 times value on the earnings, and the market price per share is rupees 20. And the market price per share is rupees 20. So if the company's share has made a certain earnings, how many times value is placed on it is what is measured by the PE ratio, So here in our example, the company has earned for every share 1.65, and the company's share is trading at 20 rupees. So that would mean that the market has placed a value of 12.12 times, and that's why for a share which earns 1.65, the market is willing to buy it at 20 rupees. So that's how we understand the price to earnings ratio. So there are a lot of applications of the price to earnings ratio. So at this stage, I'm not getting into the application, just giving you the high level meaning of what is price to earnings ratio. This is one part that we have to look into. The next is what we call as the earnings yield. So let me define this. Earnings yield is very simple. Earnings yield is defined as earnings per share divided by market price per share. Earnings per share divided by market price per share. Basically, you can see that this is the reciprocal of the price to earnings ratio. This is the reciprocal of the price to earnings ratio. Earnings yield here is earnings per share divided by market price per share. So here it is 1.65 divided by 20. Now, since this is yield, I am expressing this as a percentage. So into 100, this is going to be 8.25 percentage. Whenever the word yield is used, it is like a benefit or a return. So we understand that ratios which are in the nature of return, they are expressed in terms of return on investment. That's expressed as a percentage. So similarly here, earnings yield is also expressed as a percentage, 8.25 percentage. So this is the definition and this is the calculation. But what would this mean at a very high level? If I pay 20 rupees and buy this company's share, I'm eligible for an earnings of 1.65. So to be eligible to get 1.65, what should I invest in this share? 20. So the return, it is something like a return on my investment in share. So here I'm talking about investment only as investment in the share. In this limited context, it is like an ROI. If I invest 20, I will be able to earn 1.65. The company earns 1.65 for me. So that is what we understand of earnings yield. So we looked into price earnings ratio, its definition and calculation, and a quick high level understanding. Similarly, we looked into earnings yield, its definition and calculation, and also a high level understanding of earnings yield. So again, let me repeat. I've told this several times, but let me repeat once again. There's just a lot more here. For example, let me go to market price per share by earnings per share, PE ratio. Well, what market price do I take? Let's say a company has released its earnings for one quarter, but in that quarter, let's say out of 3 months, 90 days, let's say trading happened on, just an example, 70 days trading happened. So there could be 70 different market prices. Even within a day, market price can keep changing. So there can be a lot of market prices in that quarter, and the company has released one earnings per share. So what market price do I take and use for my PE ratio calculation here? Further, do I take the earnings per share that has already been announced by the company, basically the earnings that has already happened, or do I forecast the earnings per share that's likely going to happen tomorrow and take that here in my price earnings ratio calculation? Similarly here also in earnings yield. So there's a lot of discussion there, right? So, but we're not getting into that. We're just looking at this at a very high level. It's enough if we understand at this stage so much, right? So this is price earnings ratio and earnings yield. So this completes the third part of the question. So we've addressed all the requirements of this question and we have finished problem 5. So quick recap of problem 5. We did a lot of reverse working and constructed the income statement from which we calculated the two leverages applying the simple formula. And then the second part was about cover for preference and equity dividends. And this was about price earnings and earnings yields. Right. Let's go to the last problem in this topic, which is problem 6. Problem 6 is also going to be a reverse working question to a fair extent. Problem 6 is also a past exam question. This has appeared in May 2018. Okay, so they've given us, the question has given sales, has given interest, has given operating leverage, has given combined leverage. They want us to calculate financial leverage, fixed cost and PV ratio. Let's see what PV ratio means when we come there, but let's take requirement by requirement. Let's first look at financial leverage. So we've seen that combined leverage can be calculated as operating leverage into financial leverage. So if I know my combined leverage and I also know my operating leverage, obviously I can reverse work and calculate financial leverage, which is what we are going to do here, because we know the combined leverage is 2.16 times and the operating leverage is 1.2 times. So let me reverse work and get my financial leverage. And I get that to be 1.8 times. And this addresses the first part of the question, financial leverage. Let's go to the second part where they ask us to find out fixed cost. Let's see how this has to be done. Financial leverage can be expressed as EBIT divided by EBT, can be expressed as EBIT divided by EBT. This can further be expressed as EBIT divided by EBIT minus interest, because basically earnings before tax is earnings before interest and taxes minus interest. This is what I got in the previous calculation as 1.8. So I'm going to use this, and I know interest is given in this question as 10 lakhs. So I'm going to use this to get my EBIT first. So let me put this here again. EBIT divided by EBIT minus interest. Interest is 10 lakhs. So let me put that here. 10 lakhs is going to be 1.8. So let me take this to the other side. EBIT is equivalent to 1.8 into EBIT minus 10 lakhs. So which would mean, yes, if I just expand this, EBIT is 1.8 EBIT minus 18 lakhs. So bringing things to the other side, 18 lakhs is 1.8 EBIT minus EBIT, which means 18 lakhs is equivalent to 0.8 EBIT, which means EBIT is equivalent to 18 lakhs divided by 0.8, and let's see what that is. So I get 22 lakhs 50,000. So my EBIT is 22 lakh 50,000. I have my EBIT now and I have my operating leverage. So with this, I will be able to calculate contribution, and the difference between contribution and EBIT has to be fixed cost, which is what I require here. So let's do that. Let me go to the next sheet here. So I have operating leverage, and this operating leverage is going to be given as 1.2 times. So, and I know the formula for operating leverage is contribution divided by EBIT. So I know my EBIT here, that is 22 lakhs 50,000. I don't know the contribution, which is what I want to find out, and I'll definitely be able to find out by multiplying. So my contribution here is 22 lakhs 50,000 into 1.2. So that is 27 lakhs. That is 27 lakhs. So contribution is 27 lakhs. Fixed cost is the difference between contribution and EBIT. So if you look into the income statement, how would we have calculated EBIT? Contribution minus fixed cost. So that means fixed cost is contribution minus EBIT. So I know the contribution is 27 lakhs and I know the EBIT is 22 lakhs 50,000. So that would give me my fixed cost 27, which is 4 lakhs 50,000. So this is the fixed cost. So this addresses the second part of the question. The third part of the question is PV ratio. PV ratio is defined as contribution by sales. This is generally expressed as a percentage, so we multiply this into 100. So here contribution is 27 lakhs. The sales is given as 100 lakhs. So multiplied with 100, I get 27%. PV ratio is sometimes also referred to as contribution to sales ratio. Basically, it measures for every 1 unit of sales generated, how much remains as contribution. Basically, so much remains as contribution after whatever needs to go for variable cost goes away. So that's what is measured by the PV ratio. So a higher PV ratio indicates a higher PV ratio indicates lesser variable cost. So here in our example here, 27% is the PV ratio. So this addresses all the requirements of problem 6. So we have completed solving problem 6. So with this, let's conclude our discussion on leverages. So we have done 6 problems. The first problem was an introductory problem where we discussed in detail and understood in detail about operating, financial and combined leverages. And the second problem was introduced us to 2 ratios, capital turnover ratio and return on investment, and then the leverages part was tested again. The third problem was very simple. It just required the calculation of the 3 leverages in 4 cases. Each case differed from the other in terms of the operating fixed cost and also the capital structure, and because of that the interest amount also. Problem 4 was construction of the income statement and then calculation of the 3 leverages, where the only thing that we had to look at was the calculation of sales using the total assets turnover ratio. Once we got the sales, then the income statement would just follow, and so would the calculation of the 3 leverages. Problem 5, which was the previous problem that we did, the second last problem, we had to do a lot of reverse working, prepare the income statement, and from that calculate the 2 leverages, and we were introduced to 4 ratios: cover for preference dividend, cover for equity dividend, price earnings and earnings yield. For each of the 4 ratios, we understood the definition, we went for the calculation, and we also had a high level understanding of what these ratios would mean. And then the last problem, which is the one that we just did, was problem 6, where this was also a past exam question and a reverse working question, where we first had to find out financial leverage using combined and operating leverage, and we had to also find out fixed costs using the formula of financial leverage and operating leverage and a little bit of reverse working, and PV ratio was pretty straightforward. Yes, so thank you for watching this video. Please subscribe to my channel on YouTube, Learn with Sri. I hope you enjoy the learning experience. Thank you again.